March 2023. A bank that survived 2 world wars, the Great Depression, and the 2008 financial crisis collapsed in 72 hours. Not from a market crash. Not from a recession. From cocaine, lies, and a series of decisions so catastrophically stupid that regulators are still trying to figure out how nobody stopped it sooner. Credit Suisse didn't just fail. It face-planted in front of the entire world while holding $1.4 trillion in assets. And the wildest part? They saw it coming. They just didn't care. So let's rewind and figure out how one of the world's most prestigious banks turned into a dumpster fire. Let's go back to 1856. Switzerland. Mountains. Chocolate. Neutrality. And a brand new bank called Credit Suisse. For over 160 years, this wasn't just a bank. It was the bank. The kind of institution where royalty kept their money, where dictators stashed their cash, where billionaires whispered their secrets into marble halls and knew those secrets would never leave. Credit Suisse built its reputation on 3 things: discretion, stability, and Swiss banking laws that made Fort Knox look like a lemonade stand. They financed railroads, funded wars, survived the Great Depression while other banks exploded. When World War II ended and Europe was rebuilding, Credit Suisse was there, lending, growing, expanding. By the 2000s, they were a global powerhouse. Offices in every major city, trillions under management, investment banking, wealth management, asset management. They did it all. And their brand? Untouchable. If you banked with Credit Suisse, you had arrived. But something started shifting. Quietly at first. Then all at once. Because while the logo stayed polished, the culture inside was rotting. Here's where things start getting sketchy. Credit Suisse had a problem. They were too hungry. Banks are supposed to be careful. Boring even. They assess risk. They say no to bad clients. They protect their reputation. Credit Suisse? They said yes to everyone. Drug cartels? Sure. Corrupt politicians? Welcome. Tax evaders? We have a special department for that. In 2014, Credit Suisse pleaded guilty to helping wealthy Americans evade taxes. They paid a $2.6 billion fine. That's not a slap on the wrist. That's a felony conviction. A major global bank admitted to crimes. But did they change? No. They just got quieter. Then came the cocaine client. Between 2004 and 2008, Credit Suisse did business with a Bulgarian smuggling ring that trafficked cocaine hidden in cans of tuna. Yes, really? Tuna cans. The bank processed over $140 million in suspicious transactions. And when investigators asked questions, the bank's answer was basically, "Whoops, didn't notice." They were fined. Again. But the client relationships continued, because saying no meant losing revenue. And revenue was all that mattered. Then things got bizarre. 2019, Credit Suisse's head of wealth management, Iqbal, announced he was leaving to join their rival, UBS. Normal, right? People switch jobs. Except Credit Suisse didn't take it normally. They hired private investigators to follow him. Not just watch him. Stalk him. Track his movements. Monitor his family. Record his meetings. Iqbal noticed. He confronted his stalkers in the middle of Zurich. A physical altercation broke out. Police were called. And when the story broke, the world learned that Credit Suisse had been spying on its own executives like some kind of corporate KGB. The CEO resigned. The head of HR resigned. But the damage was done. Because if this is how they treated their own people, what were they doing to everyone else? March 2021. Bill Hwang, a former hedge fund manager, was running a family office called Archegos Capital. Family offices are supposed to be small, quiet, and boring. Archegos was none of those things. Bill Hwang was using something called total return swaps. Essentially, he was making massive bets on stocks without actually owning them. He was borrowing from banks to place leveraged trades, and the banks had no idea how big his bets actually were. Because here's the trick. He was doing this with multiple banks at once. Morgan Stanley, Goldman Sachs, Nomura, and Credit Suisse. Each bank thought they were his only partner. None of them knew he was overleveraged with everyone. Hwang was betting billions on stocks like Viacom, CBS, and Discovery. And as long as those stocks went up, everyone was happy. Credit Suisse was earning fees. Hwang was getting richer. The machine hummed. But then the stocks started falling. And when they fell, Hwang couldn't cover his margin calls. The banks panicked. Morgan Stanley and Goldman Sachs got out fast. They dumped Hwang's positions immediately, took losses, moved on. Credit Suisse? They hesitated. They wanted to negotiate. They wanted to salvage the relationship. They wanted to believe Hwang could recover. By the time they finally sold, the damage was catastrophic. Credit Suisse lost $5.5 billion in a single trade from one client. Morgan Stanley lost $900 million. Goldman lost even less. Credit Suisse got obliterated. And the reason? They were too slow, too trusting, too desperate for fees. But Archegos wasn't even their worst mistake. That honor goes to Greensill Capital. Greensill was a supply chain finance company. Sounds boring. It was. Except it was also a massive fraud waiting to explode. The business model was simple. Greensill would pay suppliers early on behalf of big companies, then collect from the companies later. It was supposed to be low risk, steady income. Except Greensill started making up invoices. Fake suppliers. Fake receivables. Fake everything. And they packaged those fake invoices into investment funds and sold them to, guess who? Credit Suisse. Credit Suisse created $10 billion worth of funds backed by Greensill's loans. They sold those funds to their own wealth management clients, retirees, pension funds, people who trusted the bank. In 2021, Greensill collapsed. The invoices were fake. The collateral was worthless. And $10 billion in client money evaporated. Credit Suisse's response? We're shocked. We had no idea. Except internal emails later showed they had been warned. Multiple times. Risk officers flagged Greensill as suspicious. Auditors raised concerns. But management pushed forward anyway. Because the fees were too good to pass up. Clients sued. Regulators investigated. And Credit Suisse's reputation, already damaged, was now in free fall. By 2022, Credit Suisse was hemorrhaging. Archegos cost them $5.5 billion. Greensill cost them $10 billion in exposure and lawsuits. Fines from past scandals kept piling up. Clients were pulling their money out. Executives were fleeing. The stock price, once over $80, had collapsed to under $4. The bank that once symbolized Swiss stability now symbolized chaos. They tried to stabilize. New CEO. New strategy. Cost cuts. Layoffs. Asset sales. But confidence was gone. And in banking, confidence is everything. Depositors started quietly withdrawing funds. Not a stampede. Just a steady, relentless drain. Billions left every quarter. The bank tried to reassure everyone. We're fine. We're strong. We're committed to our clients. Nobody believed them, because actions speak louder than press releases, and their actions screamed desperation. March 14, 2023. Credit Suisse's largest shareholder, Saudi National Bank, was asked on live television if they'd inject more capital to save the bank. The chairman's answer? Absolutely not. 2 words. That's all it took. Within hours, the bank run began. Not the old-fashioned kind where people line up outside branches. The modern kind. Digital. Silent. Devastating. Clients moved billions with a few clicks. Institutional investors pulled out overnight. Trading partners stopped doing business. The Swiss stock exchange watched Credit Suisse shares nosedive. By March 15th, the bank had lost $10 billion in withdrawals. In a single day. Regulators panicked. This wasn't just a bank failing. This was systemic risk. If Credit Suisse collapsed completely, it could trigger a global financial crisis. Lehman Brothers all over again. The Swiss government had no choice. They forced a merger. UBS, Credit Suisse's biggest rival, was told to buy them. Not asked? Told. The price? $3.2 billion. For a bank that was once worth over $50 billion. UBS didn't want them. They knew Credit Suisse was toxic. But the Swiss National Bank offered guarantees, backstops, and $100 billion in emergency liquidity. Basically, take them or we all go down. On March 19, 2023, the deal closed. Credit Suisse ceased to exist. 167 years of history. Gone. Absorbed. Erased. Shareholders were wiped out. Bondholders lost billions. Employees lost their jobs. Over 9,000 people were laid off in the merger. But the executives? The ones who made the decisions that destroyed the bank? Most of them had already left. With bonuses. With golden parachutes. With their reputations somehow intact. The CEO who oversaw Archegos walked away with millions. The risk officers who ignored Greensill warnings moved to other firms. The board members who approved cocaine clients retired to their Swiss chalets. Meanwhile, clients who trusted Credit Suisse with their savings, their pensions, their futures, they got nothing. Just apologies and legal paperwork. This wasn't a random failure. It was a culture problem. A greed problem. A too big to fail but too reckless to survive problem. Credit Suisse spent decades chasing growth at any cost. They took on clients nobody else would touch. They ignored red flags because the fees were too good. They prioritized short-term profits over long-term survival. And when things went wrong, they didn't fix the problems. They hid them. Until they couldn't. The collapse revealed something uncomfortable about modern banking. Prestige doesn't equal safety. A 167-year legacy doesn't mean competence. And just because a bank is too big to fail, doesn't mean it won't. If this made sense, subscribe. We'll keep it simple. Credit Suisse's collapse taught us something simple. Trust takes centuries to build and 72 hours to destroy. They survived world wars. They survived depressions. They survived financial crises. But they couldn't survive their own greed. And the scariest part? They're not the only bank operating this way. They're just the one that got caught. The question isn't whether another bank will fail. It's which one. And how fast. Because when the foundation is built on lies, cocaine-filled tuna cans, and billion-dollar mistakes, it doesn't matter how old the building is. Eventually it falls.